Well, today it would seem that Powell's speech yesterday, trying to calm the markets, trying to reassert control, was a big failure. Powell tried desperately to convince Wall Street that rates are not going to go up, that they're not even thinking about raising rates. That essentially I don't think I mentioned this yesterday, the qualification for raising rates was partially tied to the labor force participation rate returning to where it was pre-Wu flu pandemic virus shutdowns. And if 2008 is any indication, after 2008, labor force participation rate, it went down because people were struggling to find a job, and it never went back up. So the unemployment rate came down, yeah, but the labor force participation rate never did recover, meaning that there was just a new class of permanently unemployed people after 2008. The same thing, I think, is going to happen this time. Even if we were to have a normal recovery and unemployment went down, I don't think labor force participation would ever recover to where it was. And I think that Powell knows that too, which is why he's saying that raising rates would be partially dependent on that. So he can use that as an excuse to never raise rates. But nevertheless, bond yields continue to climb. It used to be that Powell coming out and giving us a very dovish speech talking about how much money he was going to print and hand out to Wall Street would, create a sense of euphoria. It would lead to all this buying. It would lead to stock prices shooting up to the moon. But in more recent times, Powell's speeches have been followed by a sell-off. People have had a tendency to buy the rumor of whatever it was Powell was going to say and then sell the fact of whatever it was he ended up saying. And I think we're partially seeing that here, in the market today. But fundamentally, if Powell was successful in convincing people that he is in control of the rate of interest in this country and that he's not going to raise it, and that yields shouldn't be going up, well, then they wouldn't be going up. In fact, if he was successful, since they had been going up prior, they should be going down today and in the future, as long as people believe Powell. But the fact that the 10-year yield is now over 1.7%, and intraday it got up to 1.75, again, we're getting closer and closer to 2%. And apparently, as of today, the yield on the 10-year bond has gotten as high as the dividend yield on an S&P 500 index fund. So what that means is that if you're someone who owns, an S&P index fund, and you just want to collect your dividends, and that's what you're using for income, you can get that same level of income off of the 10-year government bond, which is considered to be much safer and much more stable. And so if this has any effect at all, it will be to draw more people into the market to buy 10-year bonds. And, perhaps that will be enough to try and suppress yields a bit. Maybe that will help stabilize the 10-year yield, because people will be coming in to buy those bonds to get that, to get a yield that's on par with an S&P index fund. But even still, if the consensus on Wall Street is that yields need to rise, then they're going to continue to rise. Now, so far, this rise in yields is hurting the tech sector most. It's hurting the NASDAQ, your Tesla types. And the reason for that is obvious. It's that, these are your most speculative stocks. Tech, it's all about innovation. It's not so much about having a decent balance sheet. It's not about generating revenues or profits. When most people buy these tech stocks, they're buying an idea. And fundamentally, the reason why people like to speculate on those sorts of assets is because they're chasing yields, because they're so desperate to get anything that will grow at all, that they have to risk their money on that sort of investment. And likewise, the banks, when money is cheap and when interest rates are low and the banks are looking for yields, they too will invest in these tech companies and will help prop up these tech companies. They will loan them money, and then these these businesses will grow, and there'll be lots of this is essentially all malinvestment. That's what your tech sector is going to be where most of your malinvestment is concentrated. Because when you're chasing yield, you ultimately will take too many risks, and things will not work out well in the end. But with yields starting to rise, we are of course seeing a rotation out of these high growth stocks into the value stocks, and I won't get into that. You can find plenty of people to talk about that. But it should be noted that if yields continue to rise, we'll see a lot more than just a rotation out of growth into value. We're going to see a real devaluation of risk assets as such, because right now everything is in a bubble. Yes, your tech stocks are sort of the most extreme and vulnerable example of assets that are in a bubble, but pretty much all assets are in a bubble right now. And so you're going to see the rest of the stock market take a hit. Bonds, of course, will continue to take a hit. Real estate will take a hit because as mortgage rates go up, the price that somebody can afford is going to go down. And so if interest rates rise for everybody, well, then everybody is going to have to, will be able to afford a less expensive house than they otherwise would have, or than they did, a few weeks ago or last year. And so when mortgage rates rise, the price of housing in general must fall. But of course, before you see that, what you should be looking for is sort of a drop-off in home production. Because rising interest rates affects the demand side of the housing market, and so if demand starts to taper off because of rising interest rates, well, then the builders, there's going to be less demand for housing and for new housing, so the builders are going to start building less homes, which is something that I greatly look forward to. Although as fast as things are being built in Florida, I almost, relatively speaking, we're growing so much faster than the rest of the country, in large part thanks to the fact that we still have our freedom here. There's even more people who want to move here than usual. But nevertheless, hopefully the construction will slow down at some point, and it certainly will if rates are allowed to continue rising. So, as I've been saying, the Fed needs to whip out the big guns. They got to do something to impress, because yesterday was another dud. What Powell did had no effect. It did not slow down the rise in yields, it would appear, in any sense. I mean, we're well on our way to 2% on the 10-year, and from there, who knows how high it will go. But to me, it's pretty clear that the yields are rising in response to the Fed's actions. So if all of these economic issues, inflation, rising yields, which are the same problem, go back to what the Fed's actions are now, and Powell says, no, I'm going to continue my actions because I don't want yields to go up. I don't want interest rates to rise. I'm going to do exactly what I'm doing right now. Well, then rates are going to continue to rise because his actions right now are what's causing rates to rise. Interest rates are rising because there are fears that Powell will do nothing to try and halt inflation. Or alternatively, he does do something to try and halt inflation, and that, of course, would be, raise interest rates. So either way, interest rates are going to go up, either because inflation's pushing them up, or because the Fed chooses to push interest rates up in order to save America from inflation. But I think Powell's made himself abundantly clear so many times. That's not going to happen. The Fed's not going to do that. They're going to let inflation run as hot as it wants to do for as long as it wants to do it. Because, after all, Powell said, well, we've never had sustained inflation above 3%. It's always transitory. And it's like, well, duh. Inflation is always transitory. It ends eventually. it ends when the central bank decides to raise interest rates and drain all that excess money out of the economy. But if the Fed decides not to do that, well, then inflation will not be transitory. It will be sustained, forever until the Fed decides to do something to change it. And so the market increasingly seems to understand that this is the case. And I don't know what Powell is going to be able to do next. Again, people keep talking about yield curve control like it's a silver bullet. I'll believe it when I see it. I don't know what more Powell can do. Because sure, even if the Fed steps in to support the Treasury market, well, what about all of the other? What about the rest of the credit market? How are they going to replace the? Because if yields are rising in Treasuries, well, then because there's less demand. Well, there's going to be less demand for all the other bonds too, for similar reasons, because they're worried about inflation. They don't think that the current yields are sufficient, for the level of risk of both default and inflation that they would be taking on by loaning whoever the bond issuer is that money. And so it won't just be the federal government, whose yield curve they would have to control. They'd have to control, the entire bond market. They would have to support all of it because, if people, even if they, if the Fed steps in and says, okay, we're not going to let the federal government's, the yields on federal government bonds rise because then the federal government will be bankrupt. Well, that's fine, but, there's going to be a rise in yields across the bond market. So I just don't see how Powell can snap his fingers at this point and, back his way out of this corner. So I'll try and make this my last video about the Fed for a while. I did 3 days in a row here, sort of a pre-game show, an immediate post-game show for Powell's press conference, and then now a retrospective the next day, seeing what the effects are. But this to me, the finance is becoming very relevant again. It was boring there for a long time, and that's because the Fed was firmly in control. Well, now they're not so firmly in control. Looks to me like they're losing control, and I will continue to maintain that perspective until I see evidence to the contrary. So I will see you all then.